Hey, what's going on? It's Steve Peterson, Infinity Investments. Thank you all for joining us. It's 12 o'clock on a beautiful Wednesday. It's getting our summer going here. Hope all is well. Hope everybody's doing great. Shelter in place or not shelter in place. I know a lot of people starting to come out of the quarantine, depending on where you are, depending on what area. So as we're slowly but surely opening up, I want to welcome you. We're going to be talking about creatively financing your real estate deals today. Very exciting topic. Something I think is going to be critically important over the next couple of years in the real estate, the commercial and investment real estate market. Really, no matter where you are. I'm here in Oakland, California, in smack dab in the middle of the Bay Area, where a lot of sellers, they just want their money. They just want they go sell a property. Not only they want their money, they list a property at a certain price, they want above the asking price, right? And so as things shift, and right now in this pandemic, coming out of this pandemic, it's an interesting time because as we shut down, if you will, the economy or a big part of the economy, you know, that has an impact, huge impact. A lot of trillions of dollars have been lost. Same time, the government has pumped $1 trillion into the economy, particularly into the mortgage world. So a lot of mortgage companies still lending. Big difference from today and 2008. However, everything that glitter ain't gold. All right. So we don't want to drink the Kool-Aid of, hey, everything's great. It's just going to keep going up, um, because there has been trillions lost. The way we do things may be changing, shifting at the very least. And so while I don't think in the near future we're going to see a major real estate crash, I do think we'll begin seeing some shifting. Interestingly, in the single family home world, a lot of places in the Bay Area, house prices increased during the pandemic. Commercial real estate, investment real estate, not so much. However, prices are certainly holding in the multifamily world, although getting the deal done is much more challenging. Okay. And as we kind of get into this presentation today, I'll be talking about some things that I think can be viable solutions to some challenges that we might face, and I think I think like this: better to be prepared for a challenge and meet it head on than just think, hey, everything's good, it's going to be great, money's rolling, we're doing great, and then get smacked upside the head with something that you don't expect. In 2008, a lot of people got smacked upside the head. Although, as we go back and look, there was indicators. In 2007, there was a lot of residential banks that went out of business. And in commercial real estate, we thought, oh, we're not affected. Things continued to roll. And then about a year later, October 2008, we were greatly affected. So saying everything to say that everything is connected in our great economy that we have now. It's a global economy. It's not just what's going on in California, the Bay Area, what's going on in the South, what's going on in the East Coast, West Coast. It's really what's going on in the global economy. Everything affects everything. So what we should do is take some diligent steps moving forward and coming as we come out of this pandemic. As we come out of the quarantine, sheltering in place, let's use some wisdom. And so I think that we're not going to see a big price drop like we saw before. And a couple of reasons I think that. Number one is that in this market run up we've had over the last 7 or 8 years or so, it has really been a fundamentally sound run up in the sense of people have had to truly qualify for the loans that they're getting. Lenders have been very tough on their criteria. People have put a lot of cash transactions and a lot of large down payments into properties. And so the difference between now and the old market in the early 2000s is where people, even in the commercial real estate space, were able to get high leverage, 80-90% loans on apartment buildings and other commercial real estate, and the underwriting was very loose. So people, when it hit the fan, were able to in mass were just walking away from properties. In mass, lenders were going out of business. So there was a lot of confusion and chaos. So I don't think people are going to be walking away in mass on their property that they put 30-40% down, or they paid cash for and refinanced, or just paid cash for. Certainly not going to be walking away from that at all. And then a lot of lenders are not going out of business. In fact, a lot of the lenders got the bailout money, before it even, before we even really needed a bailout. But what the Fed is trying to do is keep this system rolling. So I think creative financing is going to be a huge problem solver as we move forward in this new market, because and I'll break down kind of some of the specific reasons, but people are not just going to walk. All right, people are going to fight, they're going to scrap, they're going to claw, they're going to figure out a way. That's what I believe. A whole bunch of other stuff going on in the society, racial injustice, civil unrest, supply chain issues. We got a lot to deal with, guys. So I like to focus on solutions, y'all. That's just the way I'm built. So let's jump into it now on this creative financing for your real estate deals presentation. And what we're going to do, if you have a question, chat it in. But then what I'm going to do is get to it. I'm going to go about 45 minutes in this presentation and spend 10 to 15 minutes at the end answering your questions and tapping in. And if you're watching this on YouTube and you're getting some value, please smash that subscribe button. Give me a like. If you don't like it, keep it 1,000. Give me a dislike. Throw a comment. Hey, I don't like this because of XYZ. I think what's important is that we can have realistic dialogues in the marketplace, and that makes us all better. I might not feel great about it, but throw me that. Seriously. So that being said, let's rock with it. Many of you may know me. A lot of y'all don't. My name is Steve Peterson. I'm the broker and owner of Infinity Investments. We're a commercial real estate investment firm in Oakland, California, established in November 2009. We were forged in a time of crisis. I really appreciate that, because I had to battle through some times in those days, right? But also, I've had the honor of serving as president for a couple excellent organizations. First and foremost, I was the past president of the California Association of Real Estate Brokers in 2017 and 2018. Also the past president of the Associated Real Property Brokers in 2015, 2016. Now, KRAB is the state board, and ARPB is the local Oakland board of NAREB, the National Association of Real Estate Brokers, which is the Black Brokerage Association. We were formed in 1947 when blacks and other minorities were not allowed to join the Realtors Association. So we formed the Realtors, and we, as a means of blacks being able to do business in the country, but also we stand for democracy and housing. And we are called Realtors. So if you ever heard that, if you've never heard that term before, we are called Realtors as opposed to Realtors. And that's something that is really, I'm really passionate about, because I do stand for democracy and housing. Now, at the same time, I also was the past president of NorCal CCIM. And CCIM, first of all, stands for a Certified Commercial Investment Member. It's a designation that you can get, but more importantly, it's a network of people in the commercial real estate industry that are moving in the same direction. So I had the honor to serve as president of that board in 2018. It was the first African-American to do so, and it was an honor and a pleasure. Also taught me a lot, you guys, about leadership and working with people, which I think we all need to learn more about. So Infinity Investments, the company, we are, like I said, commercial and investment brokerage firm that we broker deals, but we also invest. And our specialty is the sales and acquisitions of small to mid-size apartment buildings here in the Bay Area, also in the Central Valley. So that being said, let's get to the meat and potatoes. What is creative financing? I've got this question a lot. I did a short YouTube video on this topic of creative financing a little while ago, and I got a lot of questions about, hey, well, what exactly is creative financing? And you're probably not going to find that in the dictionary. But in regards to real estate, creative financing, in one way or another, I'll break it down. One way or another, the pandemic has affected the economy. While prices are holding strong in real estate, interesting, but the economy has suffered significant loss. So at some point, there will be some challenges in commercial real estate property markets. And that's why I think creative financing is important. Also, sellers in general have a lot of equity in their properties and do not want to easily concede on their price. because that means losing money. And an excellent way for a seller to get their price is to participate in the financing as a lender. This also helps the seller spread out their capital gains taxes over time. So these are some of the reasons why creative financing is important. And I'm sorry, I started the last slide a little bit, I jumped the gun, but now I want to talk about what is creative financing, okay? Because I get this question a lot. I did this video recently, and people kept asking me, what's creative financing? Essentially, creative financing in a real estate transaction involves acquiring a property using capital that is not derived from traditional bank lenders. However, this could take several forms and is one of the most misunderstood aspects of real estate investing, because this form of financing is not traditionally taught or emphasized. Like, you're not going to learn too much, although some of the terms will be on your real estate exam, but you're not going to learn too much about creative financing in like real estate school, or if you work in a real estate brokerage, or you work with the real estate agent or broker. Most real estate agents or brokers are not, or they clueless when it comes to creative financing, because they haven't learned it. It hasn't been taught. It hasn't been pushed. Really, only that topic is taught in the real estate investor circles. Okay, I first learned about it through the Carlton Sheets No Money Down real estate system back in the early 2000s. But essentially, this is a big unknown, and I want to break some of that down to you guys. And we call it creative because it involves structuring a transaction where the buyer uses some form of OPM, and that stands for other people's money, that typically comes from the seller, the person who's selling the property, in order to close the property. Also, we call it creative because all of the terms are truly negotiable. We can figure out, we can get real flexible here. And they require a creative approach to solve the seller's needs and provide an acquisition that the buyer wants. So this is why we call it creative, because it involves the buyer and seller, the entities, involved in the transaction, to think a little bit differently than how the bank or another lender would underwrite a deal or would structure a solution. That's why it's creative. And that's why I think it's going to be a huge part of this next part of the economy, as we, as buyers and sellers, figure out ways to do business. And I think also brokers and agents out there, this is something that y'all need to figure out. And believe me, I'm going to talk about the strategies that I've used before. I, as a broker, have done a lot of these or set up a lot of these transactions and still got paid. A lot of real estate agents and brokers are shy away from this because they think, oh, if I do this creative deal, I'm not going to get paid. Not true. There's ways to get it done. And here is just kind of what it is in a generality. Now, what are the benefits of creative financing? Well, first of all, you can acquire property with very low or possibly no money down, at least not your money, okay? You can also purchase a property larger than your current cash available would allow. So say you have a couple $100 grand, but you want to buy $1 million property that may require 300 to 400,000 down. If you can structure some creative financing, you can acquire that $1 million property. So it's not necessarily no money down, but you can stretch your dollar further. Also, you can obtain a mortgage from a seller even if you got bad or less than perfect credit, right? You might be turned down from a bank, but have a nice down payment. There's a lot of people out there, actually. A lot of self-employed people also may have decent credit, but their tax returns, they're writing everything off. So their income is discounted. So if you can work with the seller and not go through the bank, that also helps you out. Now, here's what I think the most important piece is. You can significantly increase your rate of return by putting less money down on a property that has positive leverage. Here's what I mean by positive leverage. Positive leverage is when the property generates a rate of return higher than the principal and interest of that property's mortgage payments. Again, so positive leverage is when a property generates a rate of return higher than the principal and interest of that property's mortgage payments. So when you now structure a piece of creative financing, which involves you putting less money down than the traditional 30-40% you have to put down, and I'm talking about commercial investment properties, now what you can do is significantly increase your rate of return, your cash on cash return, your internal rate of return. You are increasing it because you are putting less capital in and still getting that higher rate of return. So you get a higher, you can use that positive leverage to increase that rate of return. I think that's the biggest reason, the biggest benefit actually of creative financing. Now, here's another thing that's key. You can control and profit from a property without even owning it outright. And a lot of developers, by the way, will utilize these strategies to do so, to control the property, get entitlements done, prepare for their development before they have to come up with all the millions to purchase the property. So just some of the benefits of creative financing. Now, a lot of you guys, I know what you're thinking about. You're thinking, I live in the Bay Area, I live in New York or somewhere expensive. Why would anybody carry financing or do a lease option to buy or do something like that if all they can do is just put the property on the market and get multiple offers, right? First of all, that environment is not always going to be like that. It may be like that now, but it doesn't always stay. And that's what I'm saying to you guys is I think there will be a shift in the way things are done. I'm not thinking that it's going to jump off the cliff, but I definitely think you're not going to see consistently over the next 2-3 years, prices going up 10-20%, sellers being able to command what they want. So I think things will be changing. But then also, here's another reason. If a seller carries or does some element of creative financing, they minimize the amount of capital gains taxes that they would have to traditionally pay, or they spread that out over time. Okay, that's a big deal, especially if somebody owns a bunch of property or they own businesses or they're making a bunch of money. Okay, also, carrying financing can provide a stream of cash flow to the seller and security against the property, but it's truly passive to the seller, and they're no longer responsible for the management duties. A lot of sellers get bogged down by running property because it's not easy, by the way. Most of the real estate courses out there are just going to tell you everything that's great about real estate and not about, there are headaches, right? And a big part of the headaches are the tenants, toilets, trash, taxes, and the termites, stuff you have to deal with when you're operating property. So some people get burnt out on it, but they like the income that the property generates. I know a lot of people like that. And so if they're to carry financing, they could still realize a stream of income, do no work, spread their taxes out, and if anything goes wrong, they could always step in and take the property back. So another great reason. Also, this helps the seller to achieve their asking price or desired sale price if they're not on the market. I talked about earlier that I don't think people are going to walk away from properties because they put a lot of cash into the property. So if I put a lot of cash or I paid cash for a property, I don't got no mortgage, I'm not going to just discount my price just to be discounting it. Now somebody might do that because they need a bunch of cash, but people are saying, hey, well, the property is worth X. I want to get X. How can I get that? If you just put it on the market and the market's not giving you that. Well, you might try considering carrying and financing, and that can help you to achieve your price. All right. And the last thing is that carrying financing can help a seller to sell a property that has a high vacancy rate or a significant amount of rehab needed, because traditional lenders, they're not going to lend on that. And typically when a seller's selling a property, let's just say they got a 50-unit building and there's 10 units vacant, that's 20% vacancy. A lot of traditional lenders are not going to finance something with 20% vacancy on apartments. Now you have to go get a bridge loan, hard money loan, which you can get, but it's going to be expensive. And that could produce negative leverage, meaning that the interest from the loan eats away all the returns. So you don't want that either. So that's where seller financing can be a solution. And there are sellers out there that are motivated to do this. I think there will be more as the time progresses coming out of this pandemic. I could be wrong, but just having been running my business the last 10, going on 11 years, been in the business since 2003. I've seen the ebbs and flows. I think this, carrying finance is going to be a little bit more popular than it has been in the last few years. It really hasn't been that active, but here we go, y'all. Now, a couple rules of thumb before I get into the specific strategies. First of all, all things considered, now some properties you might need to work them down on price too, but all things considered, you are negotiating for terms and not so much price. Okay. In other words, the seller's going to get their price, you're going to get your terms. That's kind of like a basic rule of creative financing. When you're asking the seller to not take all their money and maybe take it back in the form of a note or take a lease from you with an option, it's kind of tough to also get them to drop their price too. Now, I've seen it done where we came in and had them drop the price and had them carry, because the only time we would do that is when the price is outrageously, it's overpriced. Because here's the thing, the next thing about rule of thumb is you still have to make sure that the property cash flows and is a suitable investment. And sometimes the seller be willing to assist in the financing because they'll be willing to do anything just to get rid of that property. And you don't want to just come pay top dollar and have them carry financing for a piece of crap. You still got to make sure that deal is a good deal. You know what I mean? The fundamentals never change. Now, I got a bunch of videos where we talk about properly analyzing real estate. And I think the cash flow model is the most, fundamental, important thing that you need to analyze on any property, whether it's creative financing or not. You can't just say, hey, this seller's willing to carry financing, I don't care about the numbers. Nah, the numbers still matter, right? So you don't want to overpay, but you want to be willing to give them a fair price, what they're asking, if you're going to be asking them to carry financing. That's what's fair and equitable, and that's what gets them, to be able to be willing to carry the financing. All right. Now, make sure here's a little hack that everybody should be aware of. Make sure all the necessary documents get properly recorded, even if the title company you're closing the deal with. Now, I'm say title company. I'm in Northern California. Title companies handle our closing and escrow. Title and escrows together. In Southern California, and I have no idea where the border of Southern and Northern California is, but it's somewhere out there. In Southern California, typically escrows and titles are two different entities. And in a lot of different states, I know lawyers handle closing. So this could vary state to state. But here's what I'm trying to say to you is that if you're working a deal like in Northern California with the title company, and let's just say you're having them, the seller to carry a second, and the title company doesn't want to record it because they only typically want to record documents that they're going to carry title insurance on, right? So if they're saying, hey, you can do that, but we're not going to do it because we're not insuring that loan, then you can have an independent escrow company record those documents. You just don't want to be the person going down to the county and recording that. You can do this. The reason I'm saying make sure it's properly recorded, because people who are not professionals at recording documents usually, majority of the time, screw it up. Okay, not sometimes. From my experience, the majority of the time, screw it up. So it's better to deal with the professionals on this, because this is, your property, the seller's own property. You don't want something stupid like, hey, the document didn't get recorded. So word to the wise, even if the title company or the escrow company you're working with is saying, hey, I can't insure this, so I'm not going to record it. Just say, okay, all good. Go through with it and have another company record that document. There's plenty of independent escrow companies that are experts at recording documents when you are. Now, if you happen to have worked in that field and know what you're doing, do what you do. Most of us don't. So I don't want to see your deal get screwed up because, you didn't handle the paperwork right. That's the easy part. All right. So just a couple rules of thumbs. We are not abandoning the fundamentals just because the seller is willing to carry. All right. So I just want to make sure I drive that home. You still want to make sure things are done professionally. These things are financing instruments that are worth a lot of money to you and to the seller. And if you are a seller, and like I said, I have a lot right now, me and a partner, we'll consider financing. It's on the market right now. Bay Point, California, it's 99 grand. We would consider carrying a second, not a first on it, but on that, we would consider selling us, carrying a second on that. So I'm speaking from real life as the buyer's perspective, but also from the seller's perspective. This can help you out. Make sure the docs are recorded properly. Big deal on this. All right. Now, let's get into the techniques. All right. And there's a lot of them. And when I got into real estate, I ordered the Carlton Sheets No Money Down program. One of the best programs, let me just say, the best real estate investing program that I've ever been through. And I have earned the CCIM designation. And in order to do that, you got to go through some real high level courses, man, and pass a very intense test, right? And all of that knowledge is really good, really excellent. The reason I say Carleton Sheets is the best is because Carleton Sheets program goes into detail on how to structure creative financing deals. He also goes into how to analyze property. He also goes into how to find property. Okay. So, I just want to make sure that I'm giving that course the propers that it deserves, because a lot of people, that was a popular webinar back in the day, or a popular commercial back in the day, wasn't no webinars. And a lot of people, if you watch late night TV, you probably saw that commercial. I know a lot of people ordered that course, but they never opened up the course. When you open up the course, you see all this stuff: master lease options, land contracts, contracts for deed, wraparound mortgages, seller carried first or second deeds of trust, joint venture partnerships, syndications, raising capital. And when you're talking raising capital, there's crowdfunding, one of the people with self-directed IRAs, 1031 exchangers. There's also preferred equity, mezzanine, structured finance. There's all kind of techniques. And what I loved about the Carleton Sheets program is he had what's called a creative options guide. And here's the meat and potatoes on that. Every technique you guys see here may not work on every property. So it pays to kind of have an understanding on the different techniques and structures, because one technique may work in one situation, but may not work in another situation. Whereas if you knew an alternative and how to break that down and make that work, you can structure that one on that deal. So you want to have multiple ways of doing it. However, what I see is a lot of investors who employ these techniques, they get a couple of these strategies they really like, and they really kind of rock with those. Those are their pillars of how they structure deals. And then maybe they can, as having a technique in their back pocket, pull that out when it's necessary. So you figure out what works best for you as I break down these different techniques. Now, let's start with the easiest one, the most prevalent form of seller financing. Is a traditional seller carried back first or second deed of trust. Now, in California, we call them deeds of trust. It's a mortgage. Deed of trust is a mortgage, the security against the property. And just so you know, when you get a loan from a bank or anyone, there is the promissory note. That is the note that details out all the specifics about the loan amount, the interest rate, the terms, payments, the balloon, all the rules. But then there is the mortgage, or in California, like we say, deed of trust. That is the collateral. That collateralizes the loan. So it puts a lien against the property. All right. And so when you utilize this strategy, the deed does transfer at close, and the actual grant deed, the ownership of the property, the outright ownership of the property, transfers at close. And what happens is the seller takes back a deed of trust in either first or second position, also associated with the promissory note that spells out the terms, just like the bank would do. So they don't give you a check for $200,000 to give them back $200,000. What they say is their equity, whatever they're going to take back, they're not going to receive that in the form of cash at close. Rather, they're going to receive a promissory note and a first or second deed of trust against the property in lieu of getting that cash. Does that make sense? So they're not going to write you a check like the bank would do, or wire in funds to the escrow. What they're going to do is take the money that they would have been getting and structure that in a first or second. Now, here's the thing. When you are in second position, or the seller's in second position, that means they're behind a first. So the first lender, this is what we also call the senior lender, has all the primary right. So there is an element of risk when you are behind a first, right? But when you're in second position, you still have collateral against the property, and you can still take back the property if your loan covenants are not met. But just know that if you take back a second as a seller, or if you ask the seller to take back a second, they are subject to the terms of the first. So if you're, as a buyer, getting a first loan and they're taking back a second, you got to make sure that you also, keep it cool with your first lender, because that does affect them in second position. Word to the wise. So here's another thing. Sellers on this typically don't run credit, okay? Because a lot of times if, if the person's credit was, they can just go to the bank and get some money. But, even if it's a second and it's not about credit, a lot of times they're just not doing that. They may want to see, they may ask that though, but usually they don't, okay? And that's typical. And even if they did, they have different criteria than the banks do. And they're not regulated like a bank is. Bank has to follow all kind of rules and regulations. The seller wants to just make sure, hey, can this buyer legitimately operate the property, or are they full of it? Because if they can legitimately operate the property, that's what they're typically more concerned with. All right. So that's a seller carry, first or second. I like to use the second, as a strategy to make the down payment lower. If you have them to carry a first position mortgage, you want to have them carry a first position mortgage higher than a typical bank's loan to value. So on commercial investment property, the bank is typically going to go anywhere from 60 to maybe 70, in some parts of the country, 75%. And then obviously if you're a multimillionaire, sometimes banks, go higher than that. But generally between 60 and 70, sometimes 75% loan to value. So if you're going to ask the seller to carry, it makes sense for you to ask them to carry a little bit more than the bank would. Okay, so that's the simplest way to get these creative financing deal done. Now, one of my favorite strategies is the master lease option. So if you're coming from the residential world, it's the same thing as a lease option, except for once you get 2 or more units, now you have to master lease that property. Okay, so a master lease option is when you take over operation of a property by leasing the entire complex. Now, it's the same concept as a regular lease option, except for that when you got more than one, you got to master lease it, right? So even if you got a duplex, now you got to master lease both units. Okay, and what happens is the optionee is the one who receives the option. So that would be the buyer. The optionor is the one who gives the option. That would be the seller. So the optionee receives equitable title, which is legal rights to the title, so long as all the covenants of the option contract are abided by within a specific time period. Now, options are always time-based. There must be a time period for the option. My recommendation is don't hang yourself by structuring an option that is too short. A 3-month option, a 6-month option. When you're structuring an option to buy the property, you don't buy it at that time. You have rights to buy it. So you want to make sure that one or two things can happen during that option period, that you can get your stuff together in order to be able to buy the property, meaning that maybe you need to get your credit better, or maybe you need to raise money for the down payment, or you can improve the property to the point where you can sell it to someone else, because you can do this. Once you have an option on a property, you can sell that property. But it would only make sense if you can sell it for a higher price than your option price is. So you got to be able to do that during the option period. And that, so therefore you want to make sure you give yourself enough time. Really, it's tight to do an option under a year. You really have to know you can close that property. I like to see most option contracts 2 to 3 years, right? But you gauge that based on the situation. Now, what is typical in this scenario is that you negotiate an amount of the monthly lease that would be credited towards the purchase price, once that option is exercised. All right. So let's just give you an example. Let's say you negotiate, let's say it's a 10-unit building. You say, Mr. and Mrs. Seller, I'm going to pay you, let's just say $3,000 a month. Okay. I'm going to collect the rents, pay the bills, pay you $3,000, and you would only pay them whatever amount if there's something left over for you. So you're going to pay them $3,000, and there should be something left over for you. But of that $3,000 that you're paying to the seller, a percentage of that $3,000 gets then credited towards your purchase price when you exercise that option, when you close on the property, when you buy the property, or when you sell it to someone else. That number is typically, well, first of all, it's anywhere, it's whatever you negotiate. But what I like to see is somewhere between 10 and 20% of the monthly payment. So if we're paying the seller $3,000 a month and we want to see $300 to $600 be credited towards the purchase price when we exercise the option. What that represents is equity buildup, just like you would be getting when you pay a regular mortgage. Okay, so that amount is it's a wild, wild west. Literally, whatever you negotiate, I advise 10 to 20%. If you can get more than that, obviously go for it. If the seller won't take, the seller's only saying, hey, I only do 5%. Don't kill your deal based on that, but you want to have a range, and I say 10 to 20%. Now, in order to bind an option, make it a legitimate, legally binding contract that's bound on both sides, there has to be what's called option consideration. So there got to be some money or something of value to exchange to basically that basically buys you the option. So something you've got to give to the seller to get that option. So we call that option consideration. It is typically an amount anywhere from, well, I put here $1 or 1% to 3% to 5% of the purchase price. I put $1 in there before because my first deal I ever did in 2003 in Pueblo, Colorado. Shout out to the people of Pueblo, Colorado. It's a great town. My boy Josh Cordova out there, one of my best friends, he lives there. Pueblo, Colorado is a great, great town. All right. Now that's where I did my first deal ever. And it was a master lease option on a 6-unit building. And I had to give the guy $1 in order to bind that. It was only $1 because he didn't care about that amount. It was a really cool guy I was working with. But there needed to be something of value to bind the contract. So that was $1. Most sellers, especially in California, are gonna want more than that. 1%. You try to 1% of the purchase price is what I would try to negotiate. A lot of them want between 3 and 5%. And know this, that money is non-refundable. It's not like an earnest money deposit in a regular real estate transaction. You put an earnest money deposit in a regular real estate transaction, the property can you back out, you can get that money back. In an option, once you give that money, okay, it's non-refundable. And during that period of time, you have control over the property. But once that time period expires, you either lose that option, or you can negotiate with the seller to extend it out. But, you have money on the risk. That's why you want to, negotiate a lower amount as possible. All right. But just don't be reasonable. That's my biggest thing. Be reasonable, guys. Don't jump over dollars for dimes trying to over negotiate or, pound on somebody. And I see people doing this all the time. But be reasonable with it. Don't kill a great deal because, they want you to put 3% up as option consideration. If you look at the rate of return and that 3% in the scheme of things, can make you, 20 or 30% on your money, then do it. All right. But just word to the wise, you want to put as the least amount down when you're talking about option consideration. But this is one of my favorite strategies. I think when a market is tight in terms of like, okay, not a lot of buildings are selling, but sellers have equity, but they're just like, look, I don't want to operate this property. I think we're going to see a lot of that in the Bay Area because the rental laws make it very difficult for someone who's not a professional to run their property. In other words, like if you just mom and popping this, it's tough. Because you make one false move, you could be in a bad spot. So a lot of people are going to say, hey, I want to sell, but I don't want to discount my price. What do I do? Huge, huge, huge opportunity for those sellers. Great opportunity for buyers to get in as well. Now, I'm going to talk about land contracts or contract for deed. I'm sorry that that says contractor for deed. My bad on the top. Contract for deed, otherwise known as an installment sale. Okay, in California, we call this a contract for deed. I've done a deal in California where it's like we contract for deed. I've done a deal like this in Ohio where they call it a land contract. Same thing. It is an installment sale where the down payment or the entire purchase price is broken down into installments. It can be monthly payment installments. It can be quarterly payment installments. It can be once a year installments, whatever you negotiate. Again, similar to the master lease option, you don't get the deed at close. You get equitable title, which means rights to the title. So it is a form of ownership. You don't own or have that deed outright. You have rights to it, though. You have rights to it, though. All right? So very, very important. And, you know, what I think the value of doing a deal like this is you can control a property where you don't have to put all the down payment down and then add value to that property, i.e. the deal we did in Columbus, Ohio. Shout out to Columbus, Ohio and the Buckeyes. They got robbed in the playoffs a couple of times, but, you know, I'm not going to talk football right now. I just hope football comes back. But shout out to the Buckeyes, Columbus, Ohio, great town. We did a deal out there where it was a land contract. The property was 40 or 50% vacant. And what we did is, you know, only the type of loan you were going to get was a hard money loan. We negotiated with the seller to do this land contract. But we put a nominal amount down and then structured payments every quarter. It was like, the property was like 52 units, $1 million purchase price. It was like 50,000 down and then increments of 25,000 each quarter. What we did once we took control of the property was we improved the property. Now, I didn't spend a ton of money rehabbing. What we did was paint, carpet, and leased up. And what we did at that time was we offered 2 months free to the tenants, because what we were trying to do, that was not typical in the area, by the way. But what we were trying to do is get good tenants. So we got a lot of people who we drew in by that 2 months free, and then lease up the property. Because once we had the property over 85%, then we were able to bring in better financing, close on that financing, and then buy the property outright. So by doing this, what we did is control the property, improve it before we owned it, and then brought on long-term financing, you know, to buy the deed outright. So very similar to a lease option, but it differs in the sense that there's going to be ongoing installment payments, typically over and above the monthly payment. All right, but the same concept applies, is that the deed doesn't transfer. You get equitable title, and you can control the property before you own it. Now, this is my favorite strategy. It's not the most prevalent or widely known, but it is an exotic blitz package, you know, type of deal. So it's not the standard, you know, seller financing. This is what we call a wraparound mortgage, or in other words, an all-inclusive deed of trust. Yes, that is on the California real estate exam, by the way. So this is not something that I made up or the real estate investor world made up. It is an actual thing called a wraparound mortgage. The official scientific language is all-inclusive deed of trust. Now, when we execute this strategy, the deed does transfer at close. That's different from the previous two strategies we talked about. The deed transfers in this instance. Now, why we call it a wraparound is because a new loan is created that encompasses the existing financing against the property, and usually includes an amount of seller equity above the existing loan amount. So here's what I mean by that. Let's just say someone is selling a property for $1 million. And let's just say they have an existing loan, the seller, of $700,000. And the buyer comes along and says, hey, I really like this property, but I don't have 30% down, or I don't want to put 30% down. Maybe the property needs fix up, and maybe that buyer does have 30% down, but would like to put a couple $100,000 in a fix up. A good strategy could be a wraparound mortgage. So, and you would do this other than the lease option or installment sale, because in the lease option and installment sale, you can do some paint and carpet and tighten things up, but you don't want to spend a couple $100,000 on rehab, because first of all, you don't have that deed. And if you can't execute on that option or installment contract, You did all that work on the property, put up all that money, which is non-refundable, and now the seller benefits from it, right? So you can do paint and carpet type of stuff, but you're not going to new roofs and blowout units and all that stuff on a lease option or installment contract. At least that's not typically advised. On a wraparound mortgage, though, you got that deed. So now you can get in there and spend the money because it's your property. So, but here's the essence of it. So let's just say the property's $1 million. The seller's loan is $700,000. It needs some work. So the buyer says, hey, I want to put 10% down. So Mr. and Mrs. Seller, I will give you your $1 million. But instead of going to the bank, I'm going to give you $100,000. Then I'm going to ask you to carry a wraparound mortgage of $900,000. Okay? $900,000 mortgage that's going to wrap around. It's going to wrap around the existing $700,000 mortgage. So at close of escrow, the deed goes from seller to buyer. The seller now has taken back a wraparound mortgage in the amount of $900,000 that wraps around their existing $700,000 loan. Okay? Now the buyer is going to make payments to the seller. Seller is going to make payments to the lender. Okay? Couple key things. When you set this up, there needs to be a neutral third-party company to collect the payments from the buyer and make the payments to the mortgage on the seller's behalf. Very, very important. That's important because, you know, you may trust that other person, but we want to have a layer of transparency. Excuse me. That you get that third party involved, they collect the mortgage from the buyer, they make the seller's mortgage payment, and there should be something left over for the seller, by the way. The seller is taking, in this example, they created a $900,000 mortgage to wrap around that $700,000 mortgage. So they have $200,000 of equity in that mortgage. They should be making something on that, right? So, you know, you have to structure and negotiate to make sure that after their mortgage is paid, they get something. That's part of the reason why they would do that, okay? Now, you need to get that third party involved. But also, I want to keep it real with y'all. This is a risk because the lender who has that $700,000 loan that we wrapped around, they don't necessarily know about all this stuff that we're doing, okay? We haven't alerted them. They're not going to approve that. And they usually have what's called a due on sales clause. In fact, they always have what's called a due on sale, meaning their $700,000 is due on sale. You sell that property, they need their $700,000, okay? So this strategy is absolutely 100% legal, moral, ethical. It's a way of getting business done, but technically will violate that lender's loan policy and particularly their due on sale clause. So the risk of that is if you execute this transaction, the mortgage company can say, hey, we found out about this. We need our $700,000 and we need it in 30 or 60 days. And they do what's called, they call the loan due. That means they need to get paid their $700,000. All right. So this is a risk. It is something that you need to be aware of. Both parties need to be aware of. There is reason for doing it. I've done this several times successfully, and it's a way of getting a transaction done that might not be able to get done traditionally. If you could just put your property in market and sell it and get all the money, you would probably do that. But let's say you're trying to do that and it's just not happening. Like, for instance, I'm looking on the market this morning, and there's a bunch of apartment buildings that have been on the market for several months. Whereas, you know, a couple years ago, nothing was on the market for over a month or two, right? Things change, right? So if you're trying to sell a property that's not selling, and it needs work, let's just say, this could be an option. And the key about it is a relationship between the buyer and seller, because as long as those payments get to the bank, here's the reality. As long as those payments get to the bank, they are not going to call that loan. They're not even going to look into it and know what's going on 9 times out of 10. All right. However, I want to be real with you guys. This is a risk that is involved in this strategy. A lot of sophisticated buyers and sellers do this, and they do it well. It's also very, very similar to subject to financing. Some of you guys may have heard of, and subject to financing is more a residential tactic where someone buys a property and just takes over the loan payments for the seller, where they buy the property, the deed transfers, and they're just making payments to the seller. Very similar to a wraparound mortgage, but the difference with a wrap is the seller's got some equity in that new wraparound, in that new all-inclusive deed of trust. Very exotic way of getting a deal done. Not the simplest way, but can be very, very effective. Now, I'm going to wrap up, and we're going a little bit late, so I'm going to try to bust this down in 5 minutes so I can get to your questions. Syndications, okay, raising capital. Let's just say you're in a situation where you tried the lease option, you tried the installment sale, you tried the seller carry first and second, you tried the wrap around. They're not working. They're like, nah, we're not selling that way. But you really like the property and maybe you don't have all the cash, or again, you don't want to put all your cash into this deal. Now you look at raising capital from investors. And I have a presentation where we go into detail. In fact, next month, that's what we're going to talk about, is raising capital and structures of raising capital, group investing. So I can do a whole presentation just on this, and I will be doing that and have done it. But just to kind of high level talk to you about some of the ways where you can raise capital from investors to acquire the cash you need to close that deal. You can put together joint venture partnerships, and those are usually LLCs. Do not own property in a joint venture structure or joint tenant structure. You can do a joint venture in an LLC structure, much better, where there's multiple managing members involved as LLC partners and not passive investors, so they're active members in management. You can also structure tenant in common deals where each investor comes in as a tenant in common. It can also be done through a Delaware statutory trust. It's a newer kind of a structure that allows people to own individual interests in properties that are qualified for people's 1031 exchanges. You can do a crowd fund, and you need a private placement memorandum for that. And you can raise capital on the internet through a crowd fund. Now, when you do that, by the way, and you raise capital, even if it's with your friend, you need to have a lawyer involved to draft, if it's an LLC operating agreement. If it's a corporation, the bylaws and all the associated documents, because this needs to be done right. Okay, and there's something, if it's an LLC, there's a subscription agreement to the LLC. Talked about the private placement memorandum. It could cost some dollars, but it can also be very, very worth it. Now, you also can have private promissory notes. Somebody puts up, let's say 50 or 100 grand with you in a deal, and they have a promissory note that's, a deed against the property. That can be done. The bottom line is in raising capital, what you're looking for is investors that have some cash. Maybe they don't have the deal, or they don't want to manage the property. You have the deal, and maybe you want to manage the property, and you guys come together. This has been done since the beginning of time in real estate and business. And I think it's also, really as we go forward, this whole idea of group economics is something that's very, very important to understand. All right. So it's just basically finding capital from other individual investors, structuring a legal entity to be able to purchase the property, and everybody's protected, they're structured, they're invested, and getting the seller all their money. So it's a way of potentially doing a deal with no money down or low money down, but it's just not your money. The money comes from other investors. All right. And when you're doing this, you take a fiduciary responsibility to the investors. You've got to be, and some things, everything doesn't go right. All right. In real estate, in life, and in business. But you want to, when you're raising capital, now you're raising the bar in terms of what your responsibilities are to those investors. All right. So take some time, learn about it. We're going to do another presentation just on raising capital and group investing, but it's another creative way to get a deal done. Now, last, and this is my bonus, but not least. Okay. When you don't got good credit, or let's just say the property is in bad shape and it's not going to, the occupancy low, you may need to go out and get some hard money and what we call structured finance. Structured finance is basically secondary financing. In commercial real estate, it's secondary financing that's stacked on top of the first loan. And it can be stacked in multiple different ways, because typically lenders and private money lenders in particular are only going to give you 65 to 70% of the purchase price and 65 to 70% of the rehab. Some lenders will give you 100% of rehab, but typically they stop about 65 to 70% loan to value. So if you're saying, hey, I don't want to put 30 to 40% down on a deal, Well, you can go out and get a mezzanine loan, and those loans will typically go to 80, 85%. Now, these are for larger commercial real estate deals. All right. You know, mezzanine lenders are typically not going under $2 or $3 million, right? So it has to be a bigger deal. And, you know, but there are, for smaller deals, lenders that will do seconds. Okay. And it's a second loan. The sexy word, the exotic word is called a mezzanine loan, meaning it's stacked on top of the first. All right. Now, creative way is you can also, there's companies that will place what's called preferred equity. And they'll go up to typically a little bit higher, 85 to 90%, because their investment is not debt. It's not a loan. They are equity partners with you in the deal. All right. But they get what's called a preferred rate of return, and their interest is preferred before you. So if the property needs to be sold to refi, they get paid before you get paid. All right. Now, a joint venture equity. Now, people can, let's say they have a property, you have a property you're going after, and somebody puts up all the cash, and then you kind of just partner with them. That's if you have a very wealthy friend or individual. There are equity funds out there, but that world is a lot harder to crack into. You kind of got to know somebody that's got a lot of money. They know you, or you got a good track record. They'll put up all the money, you run it, and just you and them are partners. Be tough, and a lot of those guys that put that money, they want to control everything. But it is another way to get a deal done. And the last thing I'll leave you with before we take questions is cross-collateralized loans. Let's say you own a bunch of property, but you don't have enough money to go and put a down payment on another property. You can cross-collateralize, meaning that put another loan against your other properties, take out money, and then go buy another property. I really don't advise that, though. It's a way. And I always, I'm gonna put out the knowledge that's out there, because I know a lot of people have done that and been successful. What happens is, if you cross collateralize a bunch of properties you love, and then you buy a property that's whack and it ain't cool, now you've leveraged your golden goose to buy the piece of, all bad. So it's not advised. I advise you that each deal should stand on its own. But if you just gotta have this deal and you can't hustle up the money in any other way, and the seller's not willing to carry financing, and you're just not able to raise capital, you don't want to deal with partners or lawyers and all that stuff, you can cross collateralize. Just know that you're leveraging the farm. So just be cool with that. So listen, y'all, I hope this was helpful. Again, if you listen on YouTube, tap in with your boy. Subscribe to the station. Throw a like. Throw a dislike if you don't like it. Give me a comment. Let's get engaged. Let's learn together, y'all. I want to put information out there to the marketplace that can be valuable to people who are buying and selling. We run a brokerage firm, and we buy properties as well. So our method and our model is to develop relationships with you guys. So that's what we're doing this for. I hope this was valuable. Now I'm gonna stop sharing my screen, and I'm gonna get into some of these chats if we got some questions and that. I see Q&A. Victor Cortez asks, how does the deed transfer if there's existing financing on the property in a wrap around finance? Excellent question. So I'm gonna click answer live. The way the deed transfers, okay, is that at close of escrow, when the money is exchanged from buyer to seller, you're gonna get a grant deed, right? We're not paying off that existing loan, right? A lot of times, traditional escrow companies, title and escrow, are not going to insure this kind of a transaction. You've got to go. There's a company called Green Escrow out of Pleasanton in Northern California. They're prevalent for working with a lot of creative deals, a lot of lease options, option contracts, wraparound mortgages. They will record the deed and provide an element of title insurance. Very difficult to get title insurance on these type of loans. Okay, so that's another thing, but it can be done, and it's done, I won't say all the time, but it is done regularly. The next question, Victor Cortez, does the new mortgage have to be more than the seller's existing mortgage? Typically, yes, because you're doing this strategy because you're putting some of the seller's equity on top of that existing loan, and then putting them in first position. It's an element of first position financing, but they're still subject to the underlying financing. So it's a little tricky, but technically, yes, you want that new mortgage to be more than the seller's existing mortgage. And I hope that was helpful. Now, we got a couple chats. All right. Okay, nothing, no questions in the chat. Just a couple comments. Look, it's been real. I hope this has been valuable to you guys. Next webinar, we're going to be talking about group investing. We're going to talk a little bit about opportunity zones, 1031 exchanges, and group economics. Something I think also that's going to be very important and relevant as we move forward out of this pandemic, out of the shelter in place, out of the quarantine. Again, I don't think this market's going to fall off the cliff. I don't know. I don't have a crystal ball. What I do think is that we're going to see some shifts and some changes. I don't think however many people lost jobs, 30, 40 million people, however many companies went out of business, how many just way of lives and way of doing things have been disrupted, that we're just going to go back to everything going up and going great. You know, I don't see that. I think there's going to be some sort of challenges that we got to deal with. I would rather be prepared to deal with the challenge. I would rather be prepared to deal with the difficulty than just go in blindly. And if we don't, if we come out of this and, you know, the market continues to roll, everything's, peaches and cream, then you can just continue doing what you need to do. But if it's not, and you're prepared, you can benefit greatly. Downturns, difficult times, chaos, pandemics is when some of the greatest, I don't want to just say wealth, but things, ideas come out of that. You know, that's where greatness really comes from, when people take that time to rise up. And with everything that's going on with this country and this world, you know, there's definitely a shift going on, you know, and with all the racial, tensions and civil unrest in the country, we need to be positive problem solvers, y'all. And that's what I'm calling upon as we just not real estate investors, buyers and sellers. We need to be positive problem solvers as a marketplace, as a region, as a country, as a world, but particularly us in the commercial investment world. Let's take our hat of positive problem solvers and let's go do some business. I hope it's been good for you guys. It's been real for me. Tap in on the YouTube and stay tuned for our next session where we're going to be talking about group investing and group economics. Thanks a lot. Y'all have a great rest of your day.